All right. Good afternoon. It is 2:02, and we are starting the options show webinar class. And there's a lot of earnings out today, and that, of course, begs Tom McEntee to be on to discuss his structures. Before we get into that, I want to discuss some basics for directional playing in options that hopefully won't be boring for professionals as well. And here's what I'm getting at. What I'm getting at is, as I put on the chat there, you should be seeing the chat on the left, something that's called VBS in the middle, and then you have the markets on your right. Okay, the last several days, I've had a couple what are called VBS signals in gold, and they've been profitable. But this is not about that. What this is about a conversation I had with a colleague, a professional, who also got a buy signal in gold and expressed it with options. And I said to myself, why didn't I do that? And I didn't do that because this system that I refined is for futures. But the reality of it is, I said, its basis is in options. So why don't we go through the concept of options and how options can create wealth? And I don't mean just by selling calls for an investor, and free up bandwidth for active traders who are, say, active in S&P, but have a feeling about something like gold, which moves infrequently, but gives nice moves when it does move, and they just don't want to have to worry about it. So very briefly, the VBS system, which is basically a ridiculous little volatility-based system, was derived from me trading options as an options market maker. And I just want to read a couple phrases from it so we can move on to the actual options so you know what I'm getting into. Every time I get a buy signal or a sell signal, it's based on volatility. Volatility, and I'll just read this. It was originally developed as an alert to when the risk of being short implied volatility is larger than being long, and vice versa. It is a probability model that handicaps risk reward. As a byproduct of its original repurpose, it gives risk reward scenarios in market direction. Due to its accuracy in predicting volatility expansion, directional applications are right or wrong quickly and is very useful in efficient use of capital. Now, we're going to bring this right to options in a second. So how VBS works. Okay, this is why volatility is important. Time is precious, price is noisy, volatility is less so. You may not understand what that means because of the vernacular, but we'll get into it a little bit more. All right, now we're not selling you on this, but what we are talking about is initially I used to use this when I got a signal to cover my short vol, which was rare, or I would use it to let my gamma run. What I wanted to get away from was using options as a way to express direction, and started using futures and stops that this thing set up. However, after having a conversation with a colleague who rarely trades gold, but put a punt on using options, I went, considering I did 5 gold trades to take maybe $10 out of a $20 move, I would have been better off just buying a call spread and going to sleep, especially if I'm a guy like Larry or other people on the site who are more active. So what I'm getting at here is, let's look at why options are another tool that you should use for expressing trades, when they're best to use, what type of criteria you should use in selecting them, and what can go right beyond the direction. And there's a couple secret weapons involved. So why don't we get off of this, right? And we'll go to this. Now, I had a client, I still have the client, the macro global fund, and they were looking, and they did a lot of, they do a lot of work in the equity market, and they were looking for a system to trade gold on a 1 day to 5 day basis. And so I showed them this. Now, this is a risk one to make too. Now, the reason I'm showing you this is because if you look at the cumulative return is 9% over a 39-month period. that's not really something to write home about, you know. And that's, you know, I look at that, and although, you know, the client, I work with a client, I came to realize that this system in gold, which doesn't move quickly intraday and doesn't really move a lot over 2 days, does tend to trend over weeks and months. So this system that I was using for them, with them, which gave returns that were, you know, 9% in 39 months, you know, that's ridiculous. That doesn't justify your existence, nonetheless your fee. However, this system works very well on daily bases in, say, oil or the S&P, and it works very well on weekly and monthly situations in gold. You know, the point is, when you have a system that is efficient and you have found the sweet spot of time for it, you pick the instrument you want to use. Now, what I have noticed and what I have done more successfully in the past is use options for longer term. So I have something written down here, and rather than go down a rabbit hole, why don't I stay with it? Okay, so we are, to get through this again, we are discussing using options in directional plays where entry and exit are systematically defined, as VBS does, as everybody has their own systems, okay? Second, if I can find number 2, second is, you really don't want to look at this, okay? Again, reiterating the VBS track record and delay. Short-term futures, short-term futures, and it works for, but it cuts profits short unless management is active. And the problem with a system that's got to be constantly actively managed is it will take up your bandwidth. And if you're an active trader, you just want to put it on and go away. And if you're an investor, you want to be able to sleep at night. So you don't want to have to worry about stops. So in stock indices and oil, daily is more profitable for this system. But in sleepy markets like gold or even natural gas, if you consider that sleepy, where weekly is more profitable and it is safer to use options. So getting off of the whole VBS thing actually and getting towards examples of what I'm talking about, let's take a look quickly at the gold market. And I'll give you an idea, and this doesn't have to be gold. This could easily be anything else. But you know, if you look at the daily gold chart, and let's get everything else off of here. You know, except for the last 3 days, you know, it may not look it on this chart, but it's a cure for insomnia. You compare it to other markets. You know, the average daily range is $6. The volatility is similar to a currency volatility, not something to actively trade, but it does tend to have nice trends, like here, and here, and here, and here. And, you know, not something you want to tie your futures positions up in if you're an active trader, which is why if you're an active trader, this type of stuff plays to options. And if you're not an active trader, but an investor, and you have a system, VBS or otherwise, or whatever you want to use, options play to it. So I'm going to give you some real examples of this. So why don't we pop those up, right? All right, why don't we pop up, where are they? Oh, I see, it's a picture, right? So I need to rotate. Here we go. Okay, so here's the first example, right? This is an example of going back to April 2017. Now, it's quantified, and I have it nicely quantified here, and this is why I'm doing this. In April 2017, I had a signal to sell oil, and not oil, to sell gold. And that signal proved profitable. But on the left is a much more profitable trade with less aggravation for active traders, set it and forget it, and defined risk reward for people who want to play like hedge funds but don't want to lose sleep like hedge funds. So on the left-hand side, I cut off a little bit of it, but basically the initial trade is in April 2017. Okay, you're buying, okay, a 1250, 1220, 1190 put butterfly. Now, I picked this structure not because I recommend it, but because as complicated as it is and as big of a commission bomb as it is, it's very well defined. And it's basically a butterfly, if you remember, long one put, short another put at a lower strike twice, and then long a third put is basically giving you a P&L graph that looks like a witch's hat. So between 1250 and 1190, you make money. You peak if the market settles at 1220. Doesn't mean you have to wait to expiration. And this is what I'm getting at. The second point about this, and this works for gold, in a market that has nice weekly trades, doesn't have to be gold, a market that has nice weekly trades or multi-week trends, and this is the daily chart I have cut out here for you. This trade cost you $4.78, and the exit, which coincided with the exit for my VBS future system, would have made you $772. So a gross profit of 161.5% before commissions. So you lay out $478, right? That's the $4.78 times the tick value of 100, and you collect $772 net, meaning you sell the butterfly out, you collect $1,250 for a profit of $772. Now, if you have an opinion on the market directionally, I'm not saying to use the structure, and you trade something constantly, you're an aggressive active trader, whether it be guys that trade the Aussie dollar and they're watching their stops 24 hours a day, whether it be oil traders who are constantly looking at the EIA, natural gas people, or Larry, who's monitoring many different metrics to make decisions. And you want to trade something that you think has a nice move coming into it, but you don't really want to have to worry about it, you'd put an option position on. And you do that not for a one-day trade. To trade options for a one-day trade doesn't work, because the VIG that you put into putting a structure on, even if it's an outright, usually outweighs the money you're going to make intraday, unless you're a market maker. So look at this structure here. Now, I don't recommend the structure. I would have said just buy a put spread, but this is a put butterfly, and the market captured most of the down move. The other thing I want you to look at now is, if you're going to be trading from anywhere from 1 week to 1 month to carry a position, you may have a different opinion, but I think my opinion is pretty well-founded. You want to trade options with 60 to 180 days left before expiration. And the sweet spot of liquidity, both in entry and exit, occurs in about that 90-day area. And you'll see here that the options used, if you can read that cutoff there, in April, right, the trade involved June options, April, May, June. So that's about 60 to 90 days out. I don't like 60, I like 90, because I figure I might hold it as long as a month. But as Tom likes to say, the theta or erosion or depreciation of the options that you're net long will start to accelerate under 60 days. So there's one example. That's a bear example, where if I had just done that instead of sold futures and put stops in and worried about all that, I wouldn't have had to watch the screen. Second example, we'll go bull side now. Oh, wrong way. Second example. This is from October 2016. Now, there's plenty of examples since then that I haven't tested yet. You saw them on the track record. But, this is another example, again, sticking with a butterfly. Get a buy signal, okay, for whatever reason, and you say, I think the market's going up, but I'm busy. I don't want to have to worry about it. I want to sleep, and I don't want to have to keep replacing my stop orders, because I'm busy feeding the kids as an investor. I'm busy, working. And as an active trader, you're spending your mental bandwidth focusing on, the wiggles and waggles in markets that matter intraday, like Facebook, for example. So in this situation, you're looking at October and you're buying a December option. Now, I agree with this actually. I would say go to Jan or Feb normally, but I agree with this because December happens to be the most liquid month all the time in gold. There's seasonality, December options matter. So in this situation, the theoretic structure, and the math was done on this, I back tested it, and people did actually do this trade. You're buying the 1300, 1350, 1400 butterfly. And when you buy this butterfly, you'll frequently look with P&L graphs at expiration and say, whoa, we want the market to go to 1350 to max out our profits. That's not what you have to do here. All you have to do here is have the market approach 1350 well before expiration. And given what I know about the market, you're going to make money if you also understand which side the skew is on, which we'll come to next. That's the hidden kicker. So in this situation, the structure costs $470, right? And it was sold November 9th, right, for $1,060 for a rate of return of 125%. These type of structures, whether it be butterflies, condors, or what I prefer, naked long, put spreads, or call spreads, these things, not only are they profitable, but they're repeatable if you're disciplined and you know what you're doing. This is, I'm coming full circle here as a person who walked away from options because I was a market maker and I understood the amount of money I made on the bid-ask vig. But, the money that I'm giving to the market maker in this world, in this electronic world, is very small. Market widths are very tight. There's really not a lot of entry vig or exit vig if you know what you're doing. And the bandwidth that I get freed up to trade other things, like, for example, I'm short Facebook today. Like, for example, as an investor, I don't want to have to worry about if I'm wrong. I want to be able to sleep. These things, I think, are worth the price of entry and exit if you know what you're doing. I wouldn't say do a condor. I wouldn't say do a butterfly, but that may fit you. So look at where the market went when the person got out. The market was trading 1256. It went to 1303. Okay, so they bought an out-of-the-money butterfly. The butterfly wasn't even in the money more than $3, right? If you look at this right here, right? If you can follow my cursor, I don't know that you can if you see it on the screen, but if you follow, maybe my arrow is there. Is my arrow there? Well, anyway, at 1303, just $3 in the money, you've doubled your money. It doesn't have to go to 1350. In fact, you're playing with fire if you do that. If you make 100% on your money in 30 days, you're out. That's 100% rate of return, on your money, and you're out. That's it. So what I'm saying here is that, what I'm saying here is I should start my fund up again, trading directionally with options. Well, that's what I'm saying. It is a market taker's world out there. And a hat tip to the professional who bought gold at 1288 when I bought it at 1288, and who, instead of chasing stops up and down for the last 3 days, just said, you know what? I'm bullish. I like it. I don't think it's going above 1315. And then, sold a call above there and bought a put before. Very complex structure for a retail person. But you get the point here. Now, the other factor I want to discuss, hopefully, in discussing options, is that there is, and this is going to sound a little bit salesy or cheesy, but it has to do with the secret weapon, if you understand skew and volatility. So first, I want to review. For trades or ideas lasting a week to a month, 1, focus on 60 to 90-day options. 2, always be net long. I'm not saying you can't be a naked shorter of options, but if the idea is to put a position on and be able to sleep at night, you got to be net long. You just have to be. I'm not saying to not be short options. I am saying if you're playing this, if you're punting, if you're speccing and you have your mind on other things, don't sell options and be a dope. Sell options if you're an active trader and you're watching that position. The third thing, the less complicated the option structure, the better. Because 1, lower commissions. 2, okay, easier execution. And 3, you'll have more choices on exit. So Opportunity Knox is buying a call in natural gas. Now, I don't know his level of sophistication, but I want you to think about this. If he's right, I'm going to say when he's right, and the market goes up, and that call goes in the money, that strike goes in the money, he has choices depending on his level of sophistication and his level of comfort. Now, if the market goes, if that option goes in the money, he can sell a call and create a call spread for a credit. He can just sell the option out and book his profit. He can sell the put that goes at that strike and then sell stock against it and be converted out. He can roll the call higher. He can sell stock. He's got all these choices because he started with a very simple structure, long a call. For example, if he bought a call spread, which is slightly more complicated, the market goes up, what's he going to do? He can't sell stock. He can't sell futures because if the market goes up, it could blow through a short strike and get hurt. The point is, simple is better because it gives you multiple choices on exit. Now, the next part, and this is going to sound possibly a little cheesy to professionals, but it doesn't demean the point. The way to augment profits using options is to know how to play skew. And skew is the secret weapon. And by that, I mean, in a market like the stock market or the stock index, the S&P, you're dealing with a put skew market. So if the S&P is trading 2,600 and you go out and you buy the 2,500 put and you sell the 2,400 put, just to keep it simple, and the market drops, you're going to make money, but not as much money as you want to because you're leaning into the skew. As the market drops, vol blows out. And as your long option goes in the money, that 2,600 put or 2,500 put, that will blow out in vol, but the 2,400 put will also increase in vol. So a spread that's worth 100 points at expiration on a wicked sell-off in the S&P won't even appreciate what you think it would in a one-day move. The point is, use the skew to help you. Skew is indicative of change in volatility, or to put it a different way, what can be called vol gamma. So skew tells you what options will benefit the most and which options will benefit the least when you are directionally right. So if you're, to keep it really simple, if you're in a market that has a call skew, or where the equidistant out of the money calls are higher than the equidistant out of the money puts, and you are bullish, well, good for you, because the call you buy is not only going to go up in value because it could be in the money, it's going to go up in value because volatility, implied volatility, will expand. That's a double-edged sword. Flip side, if you're trading a call skew market and you're bearish, okay, I like the idea of buying a put spread, because the put that you buy will go in the money. The put that you go into, close as it approaches at the money, implied volatility will likely drop. So using skew is kind of as an indicator of volatility, implied volatility changes, is a secret weapon to augmenting directional plays. I'm bullish in gold. I don't want to buy a call spread because I know volatility will blow out as we get to my short strike. So I might do something different. What it is, I'm not going to say. On the other hand, in the stock market, if I'm bearish on the stock market, which is a put skew, I'm not going to buy a put spread. I might just buy a naked put because I like that skew to work. Deltas matter. You want to know what the 20 delta put is priced relative to the 20 delta call. 25 or 30 delta also works. Those options tell you where your skew is. And whatever side has the skew has the benefit of what we call stochastic processes of volatility, meaning it defies logic, and Tom and I laugh about it all the time, but a 100-point move down in the S&P makes VIX blow out 20%, and a 100-point move rally in the S&P makes the VIX come in 20%. Makes no sense at all. But that's other people panicking, and that's opportunity for you. So that's pretty much the idea. Let me do I have any other fascinating pictures here? Probably not. I might have a picture of a tree, literally a tree. Anyway, so that's it. I don't see any questions coming in, but I want to, this is interesting. I want to keep this tight and finish here. All right, so right now, right now, and we're going to have to use gold because it's just a good educational tool. So right now, I'm going to show you why I got long gold and what I should have done. I got long gold on the very rare occasion that it started to break out. I got long here. I bought it here, and I sold it here, and I bought it here, and I sold it there, and I bought it here, and I sold it there. I should have just bought a 13.50 call spread and shut up. You know, I should have just done all that rather than worrying about it, because you generate the same commissions. If you're an active trader, you're generating the same commission stopping yourself in and out as you do the Vega on a call spread. So that's what I should have done. And then, of course, it goes to the daily, right? And the daily says you should be long, right? Actually, I went to the daily and I did get long in this area, and I took $4 out of a $10 move. But the point is, I could have taken more out if I used a trailing stop, but I didn't want to be bothered. Should have bought a 13.25, 13.50 call spread and just put an order in to sell it when it got to a certain price. And here's why, folks. Even when you're wrong, the call spread's not going to be worthless if your signal's violated. It's still going to have some premium. You know, you're risking $400 in that picture to make $800, but you're going to take it off when your signal says get out. So when your signal says get out, you're really only risking $200. You're not risking all of it. So I'm seriously reconsidering utilizing options since markets are so tight on screens. Since there is so much stochastic volatility in the markets, and frankly, I'm tired of removing and replacing and putting my stops in and out, because I'm not an active trader anymore, at least not the way I was. When I was a market maker, you know, that was a different story. But using options for structured trades, they're replicable, they let you sleep at night, and they free up your bandwidth if you trade other things. So that's it for me. But I'll throw some things at you. Oh, here we go. Vince, your example is, if one is not active but wanted to be sure, could they sell a call spread, for example? You know, that is, you know, I appreciate that question. I think you're giving me a softball there. The answer is yes. The answer is yes. And starting at the very, very simple level, anytime someone says always or never, treat that skeptically. And I said, never be short options. Okay. That's what your RJO clearinghouse wants you to know, because they don't want that risk, because their risk managers at these FCMs aren't what they used to be. But to speak right to Sunil's question, if you know your risk and you're bearish and you're not the kind of guy who wants to lay out premium, but who wants to protect premium. So for example, right now, right, actually, this is a very good question because it plays into the whole volatility thing. Sunil, this is a great time, right? And I'm gonna contrast this with Facebook. If you're bearish on gold, and I'm not saying I am, but if you're bearish on gold, okay, I'm bearish on gold because I don't think it gets above the teens, because as you know, I say that it hates the teens. I'm going to sell the 13.20, 13.30 call spread. And I'm going to take that premium in and book it, because I think that this market won't get above the teens the first time up. I also think if it does, it's just going to go right to 13.30. So I'm risking $10, right? My risk is very defined in a call skew market. That's important, because if we do sell off, Sunil's trade is a great trade for me. If I'm bearish on gold, I should be selling a 13.20, 13.30 call spread just to keep it tight. Because as the market comes off, not only will I make money as it moves away from the strikes, but implied volatility will come in. That's a home run trade. Now, I'm going to take that same trade because it works when a market is at its peak level and probably at its peak implied volatility. And I'm going to show it to you in Facebook, and I'm going to say, I don't want to do this. It doesn't mean it's a bad idea, but I don't want to sell a call spread or a put spread in Facebook, directly speaking. So right now, I am bearish Facebook. I do have a small short position. Okay, here we go. I was just going to ask about that in gold. There you go, Sunil. That's the way to go. I wouldn't do it in GLD. I would do it in gold. Gold is slightly a call skew market with implied volatility expanding as the market goes higher. So you pick the strikes that you're comfortable with. Maybe they're based on technicals. Maybe they're based on peak and skew or peak and vol. But yeah, if you're bearish, that's a great play. If you're selling a 320, 330, or 340 call spread, that's a great play. I'm in love with that idea right now. In fact, I'm hanging up right now. And I'm going to do that. But conversely, and by the way, to the point, Sunil, gold is a fickle market. It used to be a heavy call skew market. Then it went heavy put skew, and now it's back in a mild call skew market. So you really shouldn't have to worry too much about vol blowing out in a rally. It's not the S&P, but that's a market structure thing. Here's Facebook, right? Same idea. I'm going in and I'm saying I am not a premium buyer, but I want to use options to make money and limit my risk. Here's the thing. I'm bearish. What do I want to sell to play on Facebook? Well, selling a call spread is actually not a bad idea. The problem is you're going to make less money lower than you would think, and you're going to lose less money higher than you would think. Now, if you're comfortable with that way, that's fine. Why is that? The stock market and Facebook is a put skew market, and that means it's log normally put skew, which means the 30 delta put trades at a higher level than a 30 delta call, which correlates very heavily with, if the market drops, that call spread I sold, which should come in, let's say 10 points, will only come in 5 points. If the market rallies, that call spread, which should blow out 10 points, might only blow out 5 points. So think about what's more important to you, the risk or the reward. This market, selling a call spread, I'm bearish. Selling a call spread is going to make me less money than buying a put spread if the market drops. On the other hand, I'm not going to get so hurt if the market rallies. I will get annihilated if I buy a put spread, because not only is it moving against me directionally, volatility is going to come in. So it really, really has to do with what types of risk you like to manage. I like to manage X risk. I don't like to manage Y risk. I'm comfortable riding my bicycle without a helmet. I'm not comfortable riding my bicycle without shoes. It's really a poor analogy, but you get my point. I think if I had to do this over again and you put a gun to my head, that's a metaphor for traders. Sunil knows that. Gun to my head means, what's my indifference trade? I'm bearish. That's a fact, right? Okay, my signal says get bearish. Gun to my head. Do I sell a call spread, or do I buy a put spread? I'm going to sell a call spread. Gun to my head. Do I sell stock or do I sell a call spread? Well, I got to pull a Tom McEntee here and say I'm going to sell a call spread, because if the market moves sideways, my system would stop me out in, say, 3 bars, maybe 2 bars from now. But that call spread would still be making money even as we don't go lower. So yes, Sunil, you have reminded me of the virtues of shorting options. Don't tell Larry. But yeah, I think one of the metrics in deciding if you should be a buyer of, let's just say it this way, nobody's naked buying or no one's naked selling options. Our only examples are buying a spread or selling a spread. Limit your risk, limit your upside, that type of thing. You're looking at those 2 trades, whether it be a put spread or a call spread, whether it be buying or selling. Ask yourself, are you more comfortable, once you know where the skew is, are you more comfortable with making more money than you expected and losing more money than you expected, or making less money than you expected and losing less money than you expected? To bring that home, I'm bearish. If I sell a call spread in Facebook, I'm going to make less money than I expected in a sell-off. I'm going to lose less money than I expected in a rally. If I were to buy a put spread in this put skew market, I would probably make more money than I expected in a sell-off. and I would lose more money than I expected in a rally. So that is the hidden secret weapon of people who are trading options for profit. Don't be surprised when you buy a put and it's got a 20 delta and it behaves like a 30 delta. Don't be surprised. Don't be surprised when you buy an at the money option in UNG that says it has a 50 delta, but it's really a 60 delta. Anyway, it is 2:37. I don't want to take up too much time. Unfortunately, Tom is a little hung up. I think right now he's probably over at Tesla trying to figure out if he should be buying or selling diagonal call spreads. But I know he's got some cool positions on. He'll be with us Thursday, and if he comes back in time, please ask him questions in the chat. If there are no other questions, I'm going to wrap it up by saying options structures, simple option structures, can quantify your risk. They can let you sleep at night, all right? And they can make you money even without going in the money if you know how to play the game. And finally, if you're an active trader, you know, Sunil plays a lot of different markets. I'll use him as an example. He's trading oil. He sees me have a signal in gold. He happens to agree with it. He doesn't want to waste his time saying, Vince, where are you in gold now? He wants to put on a spread and walk away. Maybe he's selling a call spread as when I get bearish. Who knows? On the flip side, a person like Tracy, who is, you know, deep in the energy market. You know, I used to trade energy almost exclusively for years, but it's not my focus right now. If I get a signal in oil to say, you know, on my system, but I have a position on in futures in gold that I'm watching, you know what? I'm going to go in and put it on a vertical option structure in oil and say, talk to you later. I hope I make money. Anyway, you can create wealth with options, and it doesn't have to just be covered call writing. And if you know how to deal with skew, to repeat myself ad nauseum, you know how to play skew, you can augment those profits as well. Options are not just for volatility arbitrage. They are for making money because you're bullish or bearish. Have a great day. I will see you, or I will hear you, or you will hear me on Tuesday at Thursday at 2 p.m. And hopefully Tom will be with us then. Would love to talk a little bit more about Facebook and companies with earnings coming up. But frankly, why don't we just do this? Take a second here. All right. Tesla. Tesla says to me I should be putting on a position to be short below 292 and long above 297.5. The problem with playing options going into earnings for me is I play directionally vertically, and volatility is going to come in regardless of what the skew is, almost always. And that's a different type of play. That's a diagonal or a calendar spread play. And I do those a lot, just not so short-term dated. Anyway, have a great day. It is 2:40, and until that day.